Hello friends, how are you? I hope all of you are doing really good. So welcome to another lecture of Financial Management Revision Series for CA Intermediate November 2023 attempt. So first of all, I request all of you to please like the video, share with all your friends, and if you are watching it without subscribing to the channel, then it's my humble request, please subscribe to the channel and press the bell icon, because in the future also will be coming up lots and lots of content for all of you. Okay, so let's continue with our session. We were done with the investment decisions or capital budgeting. Now we are going to do a very small chapter in this lecture, that is leverages. Normally, this chapter has been asked many times in the examination, and it is asked for 5 marks normally, right? 5 marks question you can definitely expect from the chapter of leverages. Now, what is this leverages? The influence leverages helps us in understanding the influence of one financial variable on the other financial variable. For example, the impact of fixed cost on EBIT. Very simple terms. What is a lever? Right? A lever is a tool which is used to lift a heavy object, right? So leverage tells us that how we can increase our profits with the use of some financial variable. What is that financial variable? That financial variable is normally the fixed cost. That if we increase our sales, whether our profits will increase? Yes, sir, our profits will increase. Whether the profits will increase in the same proportion to the sales? Sir, that is difficult to say, right? So that is what we can study through leverages, that if we change our sales, let's say the sales change by 100%, what will be the impact on the profits? Whether the profits will also increase by 100% or the profits will increase by more than 100% because of the existence of fixed cost, right? I'll take a very simple example. Let's say you are getting a pocket money. For example, this is your pocket money that you are getting, right? And you have a fixed cost per month, right? So what is left with you after the fixed cost is, let's say, the profits. Your pocket money is 1,000 rupees, your fixed cost is 500. So what is the profit left with you? The profit is 500. Now, if your pocket money, if your father decides to increase your pocket money by 100%, let's say your pocket money increases to 2,000, right? If your father has decided, sir, very happy, sir, isn't it? The pocket money, sir, but it's a dream. The dreams do come true, yes, isn't it? You should dream high, because the dreams do come true if you dream it right. Now the fixed cost will remain 500. The fixed cost is not going to change. What will be your profit now? 1,500. Now, is it 100% change? No, sir. It is more than 100% change. That means this is what is known as leverage effect. The leverage effect says that as your more the fixed cost, right, your profits will increase by more percentage than the change in sales. Now, what is there, sir? This fixed cost involves risk also. Why there is a risk, sir? Because you will have to pay the fixed cost whether you are earning the profits or not. If you have taken a building on the rent, right, you will have to pay the rent for that building whether you are earning the profits or not. The landlord is not concerned with that. The landlord will say, I have given you the building for the usage, whether you are earning profits or not, I need rent, sir, right? So this involves the risk also, but at the same time this involves the return also. So this leverage effect, we studied from two angles. One is the risk involved, another thing is the return involved, sir. One is risk, another thing is return. As the fixed cost, as you keep on increasing the fixed cost, your risk will also increase, but at the same time your return, this is what the profits will also increase. Your return of using the fixed cost will also increase, right? So this leverage, types of leverage, if you talk about the types of leverage, there are basically three types of leverage, sir. If you talk about leverage, there are basically three types of leverage. One is operating leverage. Another one is financial leverage, and third one is combined leverage. Right now, what is operating leverage, sir? It is related to the operating profits of the business. This is related to the operations of the business, right? Operations of business, or what we can say related to the operating profits of the business, sir. Financial leverage is related to the financial impacts, financial aspects of the business, I can say, or financial profits or aspects of business, right? Combined leverage is the overall impact, including the operations, including the financial aspect. So there are three basic leverages that we have to do. That is all that is there in the chapter, right? So operating leverage, see this chart. Income statement, sir. You have to remember only the income statement. Everything will be calculated from this only. Sales minus variable cost, contribution minus fixed operating cost. This is fixed operating cost. For example, rent and all which is related to the operations of the business. You will get EBIT. EBIT minus the fixed financial cost, that is the interest on debt. That is a fixed financial cost. Minus taxes, you will get earnings after taxes. Minus preference dividend, you will get earnings available for equity shareholders, or what we call it as residual earnings also, right? Divided by number of equity shares, you will get EPS. Now, when we are talking about operating leverage, we say operating leverage is related to the operating profits of the business or operations of the business. That is why when operating leverage is being talked about, we'll talk about only sales to EBIT. That's it, only till the point of EBIT. Now, when we will talk about the financial leverage from operating profits till EPS, from EBIT to EPS, and combined leverages, the overall impact from sales to EPS, the overall impact is being reflected by the combined leverage. Just remember this picture in your mind, then everything becomes very easy, sir. Right? Just remember this picture in your mind. You can write it down if you want. You can pause the video, write down this notes if you want. Now, what is operating leverage? Operating leverage tells us that if we change the sales, what will be the impact on the EBIT? If we increase our sales by, let's say, 100%, whether the EBIT will also increase by 100%? No, sir. The EBIT will increase by more than 100% if there is fixed operating cost. Right? What I'm saying is, if you increase the sales by 100%, your EBIT will increase by more than 100% only if there is fixed operating cost. If there is no fixed operating cost, then the sales increase by 100%, EBIT will also increase by 100% only. Right? So this is the impact that we are studying it from the return point of view. That is the percentage change in EBIT due to percentage change in sales, right? So percentage change in EBIT due to percentage change in sales, right? This is how we read it, that percentage change in EBIT due to percentage change in sales. Right? So this is how we read it. Now, this we have studied it from the point of return. Another angle, I told you leverage is being studied from two aspects. One is the risk, another one is the return. This is what we have studied from the return, that if we change the sales, what will be the impact on the return? Now, let's study it from the angle of the risk also. Sir, whether we will be earning the sufficient contribution so that we are able to pay our fixed operating cost and earn EBIT. This is relation between the contribution and EBIT. Sir, how many times is our contribution of our EBIT? Right? So this combination is from the viewpoint of risk, because if there is a risk, sir, if you do not earn sufficient contribution, then you will not be able to pay the fixed operating cost, and obviously how will you earn EBIT, sir? You will not be able to earn the EBIT, right? So this aspect says whether we will earn sufficient contribution, to pay our fixed operating cost, and earn EBIT. Right? So this is what is there, whether this amount will be sufficient. Let's say Your fixed cost is 10,000. Now this contribution should be more than 10,000, isn't it? So you are earning 20,000, still you have EBIT of 10,000. That means your contribution is twice the EBIT. Sorry. Clear? So you are earning the contribution 2 times of the EBIT. You will be able to pay the fixed cost, and after that you are earning the operating profits. Right? So these are the two relationships under the operating leverage. Now, the second aspect, that is financial leverage. Now he says, okay, fine, you have earned profits from your operations, that we have understood, right? But if this EBIT increases by, let's say, if it increases by 100%, what will be the impact on the EPS? What will be the impact on EPS? Sir, will your EPS increase by 100%? No, sir, it will increase by more than 100% if there is a fixed financial cost and the fixed preference dividend cost. If these two costs exist, your EPS will increase by more than 100%. So it is a relationship between EBIT and the EPS. Right? The first relationship was between the sales and the EBIT. The second relationship is between this EBIT and the EPS. Let's see. So financial leverage is the percentage change in EPS due to percentage change in EBIT. So this is from the viewpoint of return. How we read it? The percentage change in EPS due to percentage change in EBIT. Now it will be more than 100% if there is a fixed financial cost which is involved. Clear? Another thing, sir, from another angle that shows is the EBIT versus EBT. That means whether you are earning sufficient operational profits to pay off this fixed financial cost and you have profits, right? Whether you are earning sufficient operational profits so that you are able to pay your fixed financial cost, that is interest on debt, and after paying off that fixed financial cost you are left with certain amount of profits. That is the relation. Now this relation is from the viewpoint of risk, right? This says that whether you are earning sufficient operational profits to pay off fixed financial cost, right? So this is what is the meaning of financial leverage, right? So these two ways can be used to calculate the financial leverage. It will depend upon the question that is given in it will depend purely on the question, right? That how to use it, whether percentage change in the EPS is required or percentage change in the EBIT is required. What is there? Combined leverage is operating leverage into financial leverage. Now what is operating leverage? Contribution by EBIT multiplied by EBIT by EBT. So this EBIT will get cancelled out. The ultimate formula will be contribution divided by EBT. Now this formula says that whether you are earning sufficient contribution to pay off your fixed operating cost and your fixed financial cost, right? So this is what is known as combined leverage, sir. Another way of calculating, sir, percentage change in EBIT divided by percentage change in sales multiplied by percentage change in EPS due to percentage change in EBIT. This will get cancelled. So ultimate will be, what is the percentage change in EPS? Percentage change in EPS divided by percentage change in sales, right? So this is how the combined leverage will be calculated. But that's it, sir. This is all what is there in the chapter of leverage. I told you this is a very small chapter. Now, one important thing, sir. One important thing here to remember, there is a relationship between operating leverage and margin of safety, sir. There is a relationship between what? There is a relationship between the operating leverage and the margin of safety. What is that relationship? The relationship is inverse relationship between operating leverage and margin of safety, right? There is inverse relationship between operating leverage and margin of safety. I'll not go into the derivation, right? So operating leverage is 1 divided by margin of safety. If margin of safety is given to you in the question, so the reverse of that will give you the operating leverage, right? The reason is very simple. If you increase the operating leverage, when will the operating leverage increase, sir? Only if you increase your fixed operating cost. Now, increase in the operating leverage will lead to higher risk. The higher risk means the lower safety, the lower margin of safety. That is why there is a inverse relationship between operating leverage and the margin of safety. I will not go into the derivation. I've done the derivation in my regular batches. But here I am not going into the derivation. The simple thing that you have to remember is that operating leverage and margin of safety are inversely related, right? Now, one more thing here. When we talked about the financial leverage, we say financial leverage is equal to EBIT divided by EBT, right? So we say whether we are earning the sufficient profits, from the business to pay off the fixed financial charges. Now, the fixed financial charges are of two types, sir. One is the interest on debt and second is the preference dividend. So this EBIT calculation, just focus, this EBIT calculation, this requires special attention. If there is no preference dividend, then what you have to do is, then you can take it as EBIT. What is EBT, sir? Can I write EBT as EBIT minus interest, right? EBIT minus interest. This is EBIT minus interest, simple EBT. Now, if the preference dividend is given, then what is to be taken in the question, sir? If preference dividend is given, then you have to take EBIT divided by EBIT minus interest minus what? Sir, preference dividend divided by 1 minus tax. Why preference dividend divided by 1 minus tax? I have already explained in the last lectures also. Because, sir, preference dividend is paid after paying off the taxes. So you need to earn more amount than the preference dividend. For example, here if you have to pay a preference dividend of, let's say, 100 rupees. Okay, I'll rub little bit of it. So what I'm saying is, if you want to pay, sir, let's say 100 rupees of preference dividend and the taxes are at the rate of 50%. Sir, what you will be earning, sir? At least you will be earning 200 rupees here, so that you pay taxes 100, EAT is 100 and you pay preference dividend out of this, right? So what should be your earning before tax? What should be the earnings before tax to pay off the preference dividend? Let the earnings be X. On that earnings, you will be paying 50% tax. That should be equal to your preference dividend. So here we say X1 minus 0.5 is equal to preference dividend. So what is the value of X? Preference dividend divided by 1 minus tax rate. So this is what we are taking here. Okay, here, sir. Right? So you have to be very careful what is given in the question. Right? Another thing. In the question, what kind of a thing can be asked? Let's say you are studying about the percentage change in EPS and percentage change in sales. The question says combined leverage is given to you, right? And the question says the EPS becomes 0. Whatever is the level of EPS, now the EPS becomes 0. Let's say the EPS was 100. Now from this 100, it has dropped down to 0. He says, what will be the percentage change in sales? This kind of a question can be asked. Or in a combined question, this kind of information can be there. He says, if the EPS drops to 0, Combined leverage is there. He says calculate the percentage change in sales if the EPS drops to zero. Now, if the EPS drops to zero from whatever level it is, can you tell me what is the percentage change in EPS? In this case only, tell me the percentage change in EPS, sir. Isn't it 100% change? Because whatever the level it is, whether 20, 30, 40, 100, 200, it becomes zero. There is a 100% drop in the EPS, right? So now you have, this is 100%. The combined leverage will be given to you. Can you calculate the percentage change in sales? Yes. Right? You will be able to calculate what will be the percentage change in sales if the EPS drops to zero. This kind of a question is there in your module also. So all this is about the leverage. I don't think so there is anything else. Trading on equities, nothing, sir. Forget about it. Not really important. Yes, rest everything we have discussed. Right, rest everything we have discussed about the leverage. So as I told you that this is going to be a very small chapter, leverage, but yes, from the examination point of view, for 5 marks, very important. And if you do this chapter carefully, if you are doing all the module questions of the leverages very carefully, then this 5 marks you are not going to lose anyhow, right? So we are done with this chapter of leverages. The next chapter we'll take up for the revision is cost of capital after this leverages, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.